Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at West Cooper. Today I've been joined by my colleague Mahar Afzal, who's the managing director, and together we will be taking you through today's webinar. So now, since the last 2 weeks, we have been discussing the corporate tax guide, the corporate tax group guide, which had come out in January. And we have been discussing different sections of that guide. So we have discussed what is a tax group. We discussed what are the conditions to form a tax group. What are the responsibilities of the parent after the tax group, how to apply for a tax group, what happens, when should the company deregister, what happens when a subsidiary wants to join a tax group, leave a tax group, when there's a change of parents. So all that has been discussed in our previous chapters. So if you missed those chapters, those webinars, or if you have missed any of our other webinars, you can always go to our YouTube channel. They are there. And if you have any question, you can always email at us info@questcooper.com, and we will be happy to reply to you. So let's recap from the start that what is a tax group. So if two or more companies under the corporate tax law under Article 40 are meeting all the condition, then they can be treated as a single taxable person, which is what a tax group essentially is, that it is a single, it treats it treats two or more companies as a single taxable person. So then they are under the law looked as a one company rather than different companies. So we had also discussed that the tax group for VAT are different and the tax group for corporate tax are different. So for each tax group, you need to meet the condition under the the respective regulations. So for VAT, you need to meet the conditions which are under the VAT laws and regulations. For corporate tax, you need to meet the condition under the VAT law, under the corporate tax law. And both these conditions are separate to each other. So if a company can qualify for a VAT group, it's not necessarily they will qualify for a corporate tax group. And they don't need to be part of a corporate tax group just because they're part of a VAT group for the same parent. So it is distinct from each other and have to be looked at separately. So we discussed what are some of the benefits. So like we just said that under the law, this tax group is treated as a single taxable person. They will need to file a single tax return. The income and losses of the members can be offset in the tax group. If there's a transfer of asset or liabilities or any other transaction between the members of a tax group, it can be disregarded as well when we are determining the taxable income. Then we have discussed what are the conditions. So we just said that if the companies are meeting the condition under Article 40, so what are these conditions? We had discussed in our previous chapter, which I'll recap now. The important thing we discussed was that all of these conditions need to be met and they need to be consistently met throughout the tax period. So if even one of the conditions is not being met, so you cannot be part of the tax group. So let's look at these conditions. So the first condition is the juridical person condition. So this condition says that the parent company and each of the subsidiaries that want to join the tax group, they need to be juridical person. What it means is they need to have a legal identity separate to its owner. So private company, public joint stock company, LLC company, they can be part of a tax group, but a natural person, an unincorporated partnership, civil company, freelancers, these people cannot be part of a tax group. Resident person condition, we had discussed that a parent company and all the subsidiaries in a tax group need to be resident person, meaning either they need to be incorporated in the UAE, if they're incorporated outside of the UAE, they need to be managed and controlled in the UAE. If there is a double taxation agreement between the UAE and another jurisdiction where the company are, they need to be a resident under that agreement to be a resident of UAE. So usually when there is a double tax treaty available between the between the countries, so then there are certain conditions to be met for a country to be treated as a company to be treated as a resident in a certain company, so like a tiebreaker agreement. So these rules need to be met, and if you are a resident of one company under this agreement, then you will be considered as that for that. Then we need to meet the share capital ownership condition. So this condition says that the parent company needs to own at least 95% of the share capital of each subsidiary. So either directly or indirectly. Now, when we say own the share capital ownership, we mean that the legal ownership of the shares should be there for the parent to own. So we have seen that certain time it happens that, under agreements with the companies, they can be an economic agreement where the shares are transferred, but legally they're not transferred. So that then it does mean that this condition will be fulfilled. Then there's a voting right condition. We have discussed that share capital condition might be met, but voting right condition might still not be met because there could be cases where, for example, that company might have issued shares which don't have any voting rights. So the first condition, the share capital ownership condition would be met, but voting right condition will not be met in that case because the parent company needs to have at least 95% of the voting right in the subsidiary. Profit and net asset condition is another condition that needs to be met, which means that the parent company has to be entitled to at least 95% of the subsidiary's distributable and non-distributable profit. Also, it needs to have the entitlement to 95% of the net asset in the case of winding up or liquidation, either directly or indirectly through one or more subsidiaries. Then there is the exempt person condition. So the parent company or any of the subsidiaries, they cannot be exempt person. When we say exempt person under the law, there are certain persons who are exempt. For example, government entities, government controlled entities, companies engaged in extractive business, or companies engaged in non-extractive natural source business, qualifying public benefit entity, and so on. So if you are an exempt person under the law, so then you cannot be part of the tax group. I think the only exemption is for if there is a government taxable subsidiary, those companies can be part of a tax group. And then we have the qualifying free zone person condition, where the parent companies and subsidiaries cannot be a qualifying free zone person. So if there is a free zone person who is not a qualifying free zone person, meaning that either they're not driving the having any qualifying income, not doing any qualifying activity, or they don't have core income generating activity in the free zone, or maybe they're not meeting the de minimis threshold. So if they're not meeting the conditions to be a qualifying free zone person, or if they are meeting the condition but they are opting out and want to be taxed in the normal regime, so then those people can be part of a tax group. But if they are a qualifying free zone person, then they cannot be part of the tax group. Then we looked at the financial year condition. So the parent and each subsidiary must have the same financial year. So in case the financial year is different, then one of them has to align with the other. So either the parent can align with the subsidiaries or the subsidiary can align with the parent. But all of the members of the tax group need to have the same financial year. Accounting standard condition says that the preparation of the financial statements have to be done using the same accounting standards. So let's say one company has revenue less than 50 million, it is doing, using IFRS for SME. The other company is using IFRS, so that cannot happen. So it has to be aligned, and both the companies have to be applying the same accounting standard. So like we discussed in our previous slide, that there are certain conditions like the share capital ownership, the voting right condition, the profit and net asset condition, where we are continuously saying that the parent company can directly hold or indirectly through one or more subsidiaries. So when we say indirect ownership, so let's discuss that. So let's discuss example 1 and example 2. If you look at example 1 and example 2, company A is holding 90% of direct holding direct ownership in company B in both the cases. In example 1, company A is holding 80% of company C, which in turn is holding 10% of company B. In example 2, company A is holding 95% of company C, which in turn is holding 10% of company B. So in this case, if you look at the effective holding, so 90% is directly being owned in both the cases. In the first case, 10% is being held through company C, and company A is holding 80%. So effective ownership here is 8%. So this becomes 98. In the second example, because it's 95% is being held by company A and company C, which is holding 10%. That means effectively, indirectly, it's holding 9.5%. So it would appear in both the cases that in the first case it's 98%, in the second case 99.5%, and the company is meeting the condition. But there is one important point here, that it needs to have this indirect ownership through one or more intermediate subsidiaries. So which means that in the case of company A, this condition, in the case of example 1, this condition is not being met, because company A is holding 80% of company C. So it is not meeting the first condition, that is, company C is not a subsidiary of company A. So in this case, this condition will not be met for indirect ownership. But for example 2, where company A is owning 95% in company C, this first condition is being met, and then the second condition where it is meeting more than 95% with direct and indirect ownership together. So this is how the indirect ownership will work. Then we had also discussed small business relief. So small business relief is available where the revenue is below or equal to 3 million in a tax period. So now this we will have to look at a group level for this. So we cannot look at the companies separately. So let's take the example here. Company A and B and C are there in the tax group. Company A has 1 million revenue, company B has 2 million, company C has 0.5 million. So if you look at them separately, they will be meeting the condition for small business relief. But for the tax group, they are treated as one person, as a single person. So we will have to consolidate that. So in this case, it will be 3.5 million, which is more than 3 million. So means they cannot apply the small business relief for this particular tax group. So there is no limit for how many members can be part of the tax group, but one person cannot be part of two tax groups because, like we said, we just said that again, the first point that this tax group is treated as a single tax person. So it is not possible that, a company is in multiple tax groups. So let's look at this example. In this case, company A is holding 95% of company B, which means that company A, that company B is a subsidiary of company A. So the first condition is being met. So 95% ownership is there. Then company B is owning 95% of company C. So the indirect ownership here for company A and company C is less than 95, which is that in this case, it is 90.25. So which means that they cannot be in a tax group with company A. So company C cannot be in a tax group with company A. But company B can be in a tax group with company C, it can be in a tax group with company A. So here company B will have to decide because it cannot be in two different tax groups. So either it can be in a tax group with C or it can be in a tax group with A. Let's look at one more example here. The company A is having 95% ownership in company B. The subsidy condition is being met. Then company B is having an ownership of 50% in company C. And company A is directly having an ownership of 50% also in company C. So direct ownership is 50% in company C. And through company B, it is having 95 into 50%. So which is 47.5% ownership indirectly. So if you look at the direct and indirect together, it is meeting the 95% condition because it will be 97.5% in this case. So here company A, B, and C can be part of the same tax group. Unlike in the first example, where it was not meeting, the company C was not meeting the condition, but here company C can be part of the tax group. So now after the tax group conditions, all the conditions are being met, we can apply to be part of a tax group. The parent company will need to give this application to the tax FTA tax authorities. They will need to tell what is the effective date for the tax period. If you want to be part of a tax group for a period, you need to apply before the end of the current tax period. We have seen that we have been told that we need to have an individual tax registration number first, meaning we need to register the companies individually first and then subsequently go for a tax group. When that will happen, then most probably, like in VAT, this tax number will get suspended and a separate group tax number will be given for the whole group as a whole. Now, once the tax group is formed, now the parent company takes the certain responsibilities of the tax group. So like, for example, they will be applying for any new subsidies to join the tax group. They will be preparing the consolidated financial statements. They will be filing the tax return within 9 months from the end of the tax period, settling the corporate tax payable within 9 months from the end of the tax period. They will be the one applying for tax refund if conditions are being met, manage the registration of the group, deregistration of the group, maintain the proper supporting documents for these returns, for the financial statements and other requirements. And if there's any clarifications or complaints or inquiries need to be submitted, that will also be done through the parent company. Now, we had discussed last time that for deregistration, if one member of the group is ceasing to do business, the whole group does not disband and they can basically leave the group. For the whole group to disband, we need to look at the whole group level, that if the entire group business activity is being, is being finished, is being ended. So if that is the case, then only we will apply to FTA for this deregistration. So we have discussed about joining a tax group. If a new subsidiary wants to join a tax group, they will need to give this application jointly with a parent company to be part of this tax group. We had discussed if a company wants to leave a tax group, it can be mandatory or voluntary. They can apply themselves for this, or if they are not meeting any condition, they need to mandatory apply within 20 business days. They want to avoid any penalty. Now, of course, if there are only 2 people in a tax group, then one person leaving the tax group would also mean that the whole tax group is being deregistered, disbanded. But if that's not the case, the rest of the tax group can stay and the company can leave the tax group. We had also discussed that there can be a case where the parent company can change without the group being disbanded. So if the new parent company is meeting all the condition, or if it is meeting the universal legal successor condition, so then it can continue like this. So if you would like to know more about any of this, section of the tax group guide which we have discussed and I just recap today, please look at our lectures because we have discussed this in detail there. Now I will hand it over to Mahar, who is going to discuss with you the topic for the today.
Hello, everyone. Thank you very much. Thank you very much, Faiza, for a very detailed discussion about the conditions to form a tax group and changes required in the tax group. So we are discussing today group taxable profits. So as I mentioned, Faiza, she has already discussed in detail the conditions, the resident juridical person, 95% for conditions, not qualifying for even person, not exempt persons, same tax period and uniform accounting standard. These are the conditions. Then changes in the tax group. This is important for the changes in the tax group. When the changes will be effective in the tax group, I have just summarized into the 4 categories. You can look into this wherever we are submitting an application to the FTA. This application can be in the to form the setup to set up the tax group. This application can be to remove the subsidiary. This application can be to change the parent company. So whenever we are submitting any application to the FTA, it has been given in the guide this application will be effective from the beginning of the respective tax period or any other date specified by the FTA. Then group members fails to meet the condition. If the group members fails to meet the condition, then this will be considered effective from the beginning of the respective tax period in which the group members has fails to meet the conditions. Then if a new entity is becoming replacing the existing parent company or new entity becoming a group member, then the law said it will be effective from the date of incorporation of the new company. Then if the group member ceases to exist, might be the group members is not meeting the condition, the group member will cease to exist, might be the residency status of the group member is being changed, might be the group member, as I mentioned, not fulfilling the condition, changing the residency, or maybe there are 2 members in the group A and B. A and B is transferring 100% of its assets and liabilities to A. The B will not exist. This group will not exist as well. So wherever the group member ceases to exist, it will be effective from the effective date when this member will cease to exist. So it will be effective from that date. So this is just a summary of changes in the tax group. Rest everything Faiza she has already discussed. So taxable income of the tax group. So taxable income, we know this, the tax group is one taxable person, one registration number, one return, one consolidated financials, and one payment to the FTA. It will definitely give administrative benefits. Every entity will not be liable to submit a separate tax return, and every entity will not be liable to make payments separately. They will not be required to do the calculation of tax for separate entity. So as I mentioned, one taxable person, one return, one payment. So this is basically considered a tax group. For tax group, these are the basic benefits for entering into the tax group. So whenever this tax group has been set up, one return, as I mentioned, one payment, one calculation, and in case the parent company is not liable to make the payment to the FTA on timely basis, then all members of the group jointly and severally, they will be liable to make the payment to the FTA. Once this group is set up, how to calculate the taxable profit? This is the important thing. So might be there is as I mentioned, there is a different group entities. Group entities A is there, B is there, C is there, D is there. So this is led by a group assuming double A. This double A entity is a parent company. This parent company has a subsidiaries under it that meet all those conditions that we have already discussed. Now this is a group. Now this group, they are asking whenever their parent primary responsibility is to prepare the consolidated financial statement. So first question is basically, do they need to prepare separate consolidated financials for tax purposes? Yes. Might be for accounting purposes, there are 15 entities. Within the 15 entities, might be there's a one group or multiple groups. So each group is liable to prepare the financial statement for their tax purposes. So when are they preparing the financial statement? First of all, each individual entity in the group A, B, C, D, each individual entity in the group, first of all, they will calculate their taxable profits. Individual entity will calculate their taxable profit, then it will be consolidated. Once it will be consolidated, then all intra-group transactions will be eliminated. So if there is any transaction between A and B, it will be eliminated. A and C, it will be eliminated. A and D. So intra-group transaction will be eliminated. These intra-group transaction can be in the form of sale of the assets, liabilities, might be there is a revenue, like suppose this is a company is selling, providing services. A is providing services to B, both are part of the VAT group. This entity will be recognizing income. This entity will be recognizing expense. Loss is this entity will be discarded to calculate the taxable profits. In the same way, if A is transferring any assets to B, or any liabilities to B, so this, it will be removed from the A books, it will be added in B books as per the accounting standards. But for tax purposes, this entry will be discarded as well. So in the same way, that there might be a provision, might be the one company, this company A, B is in the valuation services, this company B is providing valuation services to A. So this company will be booking income, this company will be booking expense, this transaction will be eliminated. So basically, what are the, whatever are the transaction, intra-group transaction, all intra-group transaction will be eliminated to calculate the group taxable profit. So where we'll start? First of all, we'll calculate the separate entity taxable income. Separate entity taxable income. Then we need to calculate the group taxable profit or group taxable income. While doing this, all intra-company transaction will be eliminated. And this intra-company transaction, as I mentioned, it can be in the form of sale of the assets, provision of services, might be valuation, might be any accrual related. So whatever the transaction in between the group entities, all these transactions will be eliminated to calculate the taxable profit. These transactions can be in between the parent company and subsidiary. In this case, like double A, in between double A and A, in between A and B, A and C, A and D, double A and D, C and D. All these transactions will be eliminated to calculate the taxable profits of the group. But there is a one exception to this elimination, which is very important. So one thing will not be eliminated. Suppose, coming back to the same, this is a double A parent company, this is a company A, this is a company B, this is a company C. These are the group members. So before entering into the group, assuming there was a transaction in between B and C, and due to this transaction between B and C, this transaction has occurred in between B and C before entering into the tax group. So before entering, assuming in 2024, they have entered into one transaction, then in 2025, they have entered into the tax group. So if there is any transaction between B and C, due to this transaction, B has booked deductible loss. So there was a transaction, due to this transaction resulted loss to B, and we know this, that B can carry forward the losses. Now, before entering into the before entering into the tax group, there was a one transaction between B and C. Both of these have entered into the tax group. Due to this transaction, there was a deductible loss to B. Now, once they are part of the tax group, they will carry forward their losses. Now they are part of a tax group. Now they, assuming there is a reversal of the transaction or any other income related to that transaction. So as per the general principle, all intra-group transaction needs to be eliminated. So after entering into a tax group, if this transaction, which has already resulted deductible loss, if this transaction is generating any income between B and C, law says this income will not be eliminated unless and until this loss, whichever the company has already claimed, it has been reversed in full. Once this loss will be reversed, then this income will be eliminated as well. Basically, the objective is to avoid the double impact. Once this loss has already been booked, company has claimed, company definitely the company would have not paid any lesser tax in 2024 due to this. If loss was basically, if there is no loss, company would have paid the tax. If losses are there, company would have not paid any tax in 2024. Once the company has not paid any tax in 2024, company has carried forward the losses. Once the losses has been carried forward in the next year, when has become a part of the tax group, again they are taking benefit due to this transaction. They are asking, this transaction will not be subject to tax because this is an intra-group transaction. No, this intra-group transaction has already resulted tax losses, the benefits of which has already been taken, so we will not be able to take the double benefit of this transaction. So loss is, if there are two group entities which were not part of the group, they have entered into any transaction, this transaction has resulted in a deductible loss. This loss has not been reversed or 100%. So any income related to that transaction, it will not be eliminated unless and until that loss has been reversed. Once this loss has been reversed, then this transaction, any transaction, if this transaction is generating any income after entering into the tax group, then that income will be eliminated. So one exception to this is where a member has recognized a deductible loss in the tax period in respect of those transactions prior to joining or forming a tax group. The same thing that we discussed, B and C made a transaction, recognized deductible loss before entering into tax group. Elimination of the intra-group transaction doesn't extend to a member having recognized the deductible loss in a tax period prior to joining or establishing the tax group. The exemption only pertains to income that represent the reversals of a deductible loss from the same transaction. This is very important. Same transaction, same parties, same transactions. This is the reversal. Till the loss has been reversed, we will not eliminate. Once the loss has been thoroughly reversed, then we will be eliminated. Any revenue associated with the transaction, such as the reversal of the impairment, will be incorporated in taxable income of the tax group. Same amount as the previously deducted. Whatever the deducted amount previously deducted, whatever has resulted into the deductible loss, once that amount will be reversed, then the company will be able to eliminate the intra-group transaction related to that transaction specifically. So limitation of tax losses. This is basically, just look into this. This is a one group A, B, C. There is a new subsidiary D. Okay, this new subsidiary D, this company has losses which are carrying forward losses. This company is joining tax group A, B, C, D, ABC. Law says if this subsidiary is joining the group ABC, the group law says this group, these losses of D will be added as a group losses. So group will be able to carry forward the losses. Now, these losses which has been added into the group losses, these losses can be adjusted. There are two conditions for this. First of all, it can be adjusted maximum 75% of the group taxable profit. This is very generic condition, taxable income or taxable profit. Second, whatever are the losses, this can be adjusted from the income of D, assuming this is now D has become a part of the group. D is generating any income. So these losses of D can be adjusted against the D income only. Two conditions. First condition is maximum 75% of the group taxable profits. You can adjust maximum 75% of the group taxable profits, and these group taxable profit will be after considering D new subsidiary as a part of the group. Second condition. So the losses of D subsidiary, pre-grouping losses can be adjusted against the taxable income of D. Though this is the basically D. Losses of D will be adjusted against income of D. If D income is lesser than losses, D cannot adjust. If the group maximum adjust up to 75%. So if there are any losses, pre-grouping losses, which has not been adjusted 100% in this group, then the loss is, and in case this D is leaving the tax group, D will carry forward the pre-grouping losses. These are the pre-grouping losses. If these pre-grouping losses has not been 100% adjusted 100%, still the losses are remaining, then D can carry forward these losses with itself. So this is very clear, right? There are two conditions to adjust the pre-grouping losses, 75%, and that there should be an income of the respective subsidiary. It will be adjusted against the respective income. If this losses has not been adjusted fully, then the D can carry forward the pre-grouping losses against its taxable income in the future. Any other losses of A, B, C, or any losses of A, B, C, D, group losses or pre-grouping losses other than subsidiary, this D will not carry forward. We'll look into the example as well. In the same way, now we'll discuss the subsidiary situation. Now the same situation is A, B, C, this is the group, D is the subsidiary joining them. So if this group, the same condition will be applicable for the group as well. This is the group. This pre-grouping losses of the group will be adjusted up to 75% of the taxable income of the whole group, including D. Secondly, it will be adjusted against the income of ABCD, same conditions. And any pre-grouping losses of ABCD can be carried forward by ABC only against its future taxable income. So if D is generating any income, if the losses of D, the overall losses of A, B, C, D, so ABC even cannot carry forward all these losses because these are the group losses. So main conditions are 75% of the taxable income. Second, there should be an income of the respective party that can be adjusted. Otherwise, it can be carried forward. Pre-grouping losses can be carried forward by the respective entity. So I have considered a few examples for you from the respective guide. We'll look into the example. The first is C LLC, the UAE resident company. CLC acquired FLC, another UAE resident company on 31st March 2026. So at the top is C. This is a resident company. C has acquired F. F is a resident company as well, and they have done this on 31st March 2026. FLC wholly owned ZLC. Now FLC owns Z. Here is the 100% ownership. Here is the 100% ownership as well. 100% they are asking voting rights. It means all those conditions are being met which are required to form a tax group. Although CLLC doesn't directly own any share capital, hold any voting rights in ZLLC, it should be indirectly through its ownership of Z owners FLLC. Okay, it's fine. Therefore, they meet the ownership requirement of ZLLC in order to form a tax group. See, indirectly own 95%. Yes, they own it. They met the condition. Basically, they can set up a tax group. CLLC as the parent company, FLLC and ZLLC made an application. Joint application is required to be to the FTA to form a tax group. They made a joint application. We have already discussed. Once their application is being made to the FTA, it will be effective from the beginning of the respective tax period or any other date specified by the FTA. So beginning of tax period is 1st September. So ACFZ, they are meeting the condition. They have applied to the FTA and it will be considered tax groups from the beginning of the tax period, which is 1st of September 2026. The application to form a tax group was approved by the FTA at the end of the tax period, 31st 2020. Each group company accounting income. This is their accounting income. Basically, as I mentioned in a previous example, double A, B, C, D. First, they need to calculate their accounting income. This accounting income will be adjusted to arrive at their taxable profits. So each period company accounting, this accounting income is given during the tax period. F and Z received dividend from UAE resident company. We know this dividend and exempt income in case this dividend is being received from the juridical person, resident juridical person. If we are getting dividend, I forgot it. Basically, this is a resident juridical person or only juridical person. But this is for sure. This condition is there that we're getting the dividend from the juridical person. The word resident juridical person or without resident, but then in case we are getting dividend from the juridical person, it will be exempt. So FLLC that will receive dividend from resident companies. Resident company, they're getting dividend, should be exempt. CLC spent 250,000 client entertainment. Client entertainment, we know that we can claim up to 50% as per the guidance, as per the basically provisions of the law. CLC had 5.5 million brought forward tax losses. This is the pre-grouping losses of CLLC, previous period, pre-grouping losses. 5.5 million. In order to determine the taxable income of the period, CL must first consolidate by way of aggregating. Basically, first they need to consolidate. Once they are consolidating, all intra-group transaction will be eliminated. Domestic dividend are exempt from corporate tax. As a result, the dividend theory should be excluded. Thus, this is very clear, it should be excluded. Entertainment expenses, we can claim up to 50%. Then what they did, the taxable income is basically accounting income, this is their accounting income, this accounting income, this is total 27 million. Out of this 27 million include dividend of 3 million, so it has been eliminated, 3 million has been eliminated. So this accounting income, we have already deducted 250,000 entertainment expenses, but we are allowed only 50%, so 50% will be added back. Your taxable income is 24.125 million. So out of this, as a parent company, taxable losses incurred before grouping can be offset maximum up to 70. We have already discussed two conditions: 75% of the taxable income of the group. Then second condition is the relevant subsidiary has the income as well. So this is total taxable income of the group. Up to 75% of the taxable income of the group is 18. So maximum losses we can reverse 18,093,750, provided the relevant subsidiary has the income as well. So this was C's losses. C's income is 10 million. C's losses, C's income is 10 million, 75%, and the losses is 5.5 million. So means both of the conditions we can claim. This is 75% is our 18 million. C's taxable income is 10 million. Loss is only 5.5 million. Yes, we can claim, we can adjust 100% of the loss because both of the conditions are being satisfied. So taxable income is 24,125. Tax loss is 5.5 million. Remaining is 18,625. This is final taxable income or taxable profits. Up to 375,000, 0% corporate tax will be applicable. Beyond that, 9% corporate tax will be applicable. So the 9% corporate tax is applicable, is given is 1.6 million. They will be liable to pay to the FTA. They will be liable to submit return within 9 months from the end of the relevant tax period. On 4th of November 2027, CLLC sold 50% of its shares in FLLC. As CLLC no longer holds sufficient shares in FLLC, indirectly ZLLC, the condition of those three conditions remain good, are no longer are being met. Once these conditions are not being met, the tax group ceases to exist from the beginning of the tax period. We have already discussed, if the conditions are not being satisfied, fails to meet the condition, it will be effective from the beginning of the respective tax period, and for 2027 this group will be dismantled. Another example, one subsidiary merged with the parent company. This I have taken from the guide as well. Sorry. Company A as the parent company, company B and C formed tax group. A, B, C formed tax group starting from 31st, ending 31st December 2020. Company owns 100% shares A and B. So basically structure is A, B, C, 100%, 100%. They have set up a tax group. On 2024, company B transferred asset 1 to B in exchange for cash. One asset has been transferred from company B, transferred an asset to company C. One asset has been transferred from B to C. They are part of the tax group. We have already discussed all intra-group transaction will be eliminated. On March 2025, company B merges into A and ceases to exist. So B has merged with A. There is no existence of B now. Company B will remain a member of tax group until, okay, this will cease to exist. It will be considered to leave the tax group on 1st of March 2025. Okay, because we have already discussed, if this one company is transferring entire business to other company, it will ceases to exist. It will be effective from the date it ceases to exist. It will be effective from that date. To transfer of assets and liability are part of a legal merger. The assets and liability transferred as part of legal merger are considered to have transferred in within a tax group. Okay, immediately after the merger, company B has ceased to exist. This is considered to leave the tax group. Okay, in such case, any gain or loss on the transfer of the assets and liabilities, this portion we have not discussed. Basically, there are two companies, company A, company B. B is transferring entire business to A 100%. So loss is basically any gain or loss on this entire transfer should be booked. It should not be eliminated unless and until this loss is exempt in any other provision of the law. Any other provision might be the possibility after the transfer they are part of the qualifying group. So qualifying group, if they're part of the qualifying, they're not part of the group, but I'm asking qualifying group minimum 75% holding. So if they're not 95%, 100%, 75% strict, there is a possibility it can be exempt as well. So law is saying if one company is transferring entire its business to another company and it will ceases to exist currently in this situation, like it has been given in this situation, then the entire loss on this transfer of an assets and liabilities will be booked unless, sorry, entire gain it will be booked unless this gain is exempt in any other provision of the law. So, sorry. So in this current situation, when B is transferring entire of its assets to A, means B will no longer be meeting the conditions of qualifying group as well. So this gain will be subject to tax. So in such case, any gain or loss on transfer of the asset or liability is taken into account upon B leaving the tax group, unless the associated income would have been exempt from corporate tax taken under the provision of the law. Other provision of the law is not applicable in this situation because they are not part of the qualifying group after the transfer. If the conditions of business restructuring relief are met in relation to the legal merger of B with A, no longer gain and loss should be taken into account. Since the gain and loss would not be taken into account, the company B elected small business relief, it would not be taken into account when company ceases to exist. This is the same thing what we discussed. When B is transferring to A, they cannot enjoy business restructuring relief. They cannot enjoy group relief. These gain and loss will be subject to tax. So transfer of assets from B to C. The asset transferred by B to C on March, okay, was a transaction between two members of the tax group, therefore eliminated for determine a taxable income for tax period. Okay, this is very fine. It will be eliminated. There's one more condition, basic clawback clause that we are not discussed till now. Law says intra-group assets and liabilities will not be subject to tax, subject to the condition transferor or transferee. They are not leaving the tax group within 2 years from the date of the transfer, or they are not further transferring the assets within 2 years from the date of transfer. If they are not doing this, then it will be gain and loss. It will not be, there will not be any gain and loss. It will not be subject to tax. And if the asset is being transferred within 2 years from the date of transfer, further transferred, assuming A has transferred to B and B is transferring the asset further within 2 years, or A is leaving the tax group or B is leaving the tax group. In this situation, so initial transfer will not be subject to tax. But if this asset is transferred within next 2 years or A or B is leaving the tax group, then the gain that has already not been booked on the initial transfer, that gain will be subject to tax and transferor will be liable to book the gain. And asset will be marked at the market value in the group. We will look into the example as well. So as B ceases to be part of the qualifying group within C within 2 years from this, yes, they within the 2 years not part of the group. So basically they have not fulfilled the 2 years condition. Clawback clause will be applicable, and whatever the gain, transfer will be liable to calculate the gain and transfer will be liable to pay the tax as well. If the transferor will not exist in case of this transfer, then transferee will be liable to pay tax on this gain. This is very classical example basically. This last one, I will not take you too much time. Give me just 5 to 7 minutes, it will be over. Company A, B, and C are members of a tax group for the period 2024. Company A is the parent company and B and C are the subsidiaries. A, the structure is basically A, B, C, part of tax group. 31st March 2024. Company A transfers an asset 1 to company B. This asset is being transferred here, first of all. And this asset is being transferred on 31st of March 2024. 31st March 2024. Net book value of the asset is 1 million. Market value of the asset is 1.2 million. Then company B transfer the asset to C. Now B is transferring to C, the same asset. And this asset is being transferred on 31st March 2025. 31st March 2025. So asset has been transferred from A to B on 31st March. Exactly after 1 year, B has transferred the asset to C. But make sure, keep in mind, B and C are part of the tax group. And A is part of the tax group as well. So what happened on 1st of Feb 2027? 1st of Feb 2027, company A transferred the shares in company B to a third party. So another transaction is there. This transaction has occurred on 1st of Feb 27. So the gap in between this first transaction and this second transaction, 31st March 24, 25, 26, this is after 2 years. 2 years have passed. And the gap between these transactions and this transaction has occurred on 2025, 31st March 2025. 2 years would have been completed on 31st March 2027, but they have made a transaction on 1st of Feb. This is less than 2 years. So clawback, there are chances clawback will be applicable on this. Now, this is very obvious that the first transaction between A and B, when A is transferring the asset to B, so it will be considered intra-group transaction. It will be eliminated to calculate the taxable profit. Since the transfer of the asset from A to B is a transfer between two members of the same tax group, the transaction will be eliminated to calculate the taxable income. This is very right. Second, even though the asset has been transferred by B to C within 2 years from the date of the initial transfer, but they are part of the tax group, so this transaction will be eliminated as well. So since the transfer of the asset from B to C is a transaction between two members of a tax group, the transaction will be eliminated to calculate the taxable income, which is very fine. Third, so when A has sold the shares in B, B is no longer part of the tax group. So A has sold the shares in B on 1st of Feb 2027. From 1st of Feb 2027, B is no longer part of the tax group because A is not holding at least 95% share, because we have discussed these conditions needs to be met constantly. So these conditions are not being met. A has sold the shares to B. A has sold the shares in B. Once A has sold the shares, A is not holding at least 95% shares in B. Conditions are not being met. So B will no longer be part of the tax group from the beginning of the respective tax period. So once the B is not part of the tax group, and second thing, this transaction has occurred when the B has transferred the asset to C on 31st March 2025, then this shareholding has been sold within two. Basically, B has left the tax group within 2 years from the date of the transfer of the asset. We have already discussed that intra-group transfer of asset will not be subject to corporate tax. Intra-group transfer of assets will be eliminated. Condition is the asset has not been further sold out of the group within 2 years from the date of transfer, or B, transferor or transferee are not leaving the tax group within 2 years from the date of the transfer. In this situation, in the third transaction, transferor has left the tax group within 2 years from the date of the transfer. So once the transferor has left the tax group means clawback clause will be applicable. So now transferor needs to calculate the gain on the transfer. So what was the gain on the transfer when this asset was transferred from B to C on 31st March 2025? 31st March 2025, the gain was this is basically market value 1.4 million, book value 1 million, the gain is 0.4 million. Transferor is liable to pay the tax on this gain of 0.4 million. And for a group purposes, this assets needs to be recorded for future purposes at 1.4 million. So just look into this. As a result of the transfer of the shares from B to a third party, B is considered to leave the tax group from the beginning of the tax period. This will be the same case even if, okay, beginning of the tax period, B, assuming B has left the tax group. Transfer of assets and liabilities between members of tax group should not be eliminated where the transferor or transferee leave the tax group within 2 years. This is what we have discussed. If the transferor or transferee are leaving the tax group within 2 years from the date of the transfer, or asset is being further transferred within 2 years from the date of the transfer, then this transaction will not be eliminated. Gain will be subject to tax in the hands of the transferor. If transferor is not existing, then transferee will be liable to pay tax on the gains. The rule doesn't impact the transfer of the asset A to B. Yes, A to B doesn't affect because it has this 2 years have already passed. We have already discussed. However, B leaves the tax group within 2 years. B leaving the tax group within 2 years from the transfer of the asset from B to C on 31st March 2025. Hence, the gain and loss on such transfer shall need to be taken into account unless the associated gain and loss would have been exempt or not taken into any other provision of the law. Any other provision of the law is not applicable because they are not becoming part of a qualifying group as well. This means should be assessed if the transfer asset from B to C would have qualified qualifying group relief. No, there no qualifying group relief because this has been eliminated. And company C has not member or tax so that the clawback of relief is not triggered. As the shares of B are sold to third parties, shares of the B are sold to third party, so qualifying group relief is not applicable. 75% condition is not being met even. Company B ceases to be part of the same qualifying group as Company C within 2 years from date of transfer, and qualifying group leave would have been clawed back as well. The gain on the transfer of the asset must be determined in the hands of the transferor with the market value. This is mentioned basically 1.4 million, 1 million, 4 million gain. It will be subject to tax in the hands of the transferor. The gain of 0.4 million taken into account on the date the transferee leaves the tax group. So is included in a tax levying transfer or tax group purpose. Going forward, the asset base for asset one for tax group is 1.4 million. So basically, whatever we have discussed today, this is over from my side. If you can speak to us, if you have any question, you are most welcome. So you can give us a call. We are always there. We are ready to listen, ready to understand, ready to deliver. So whatever we have discussed today, basically, we are just recap the condition to form a tax group. Then we'll discuss any changes in the tax group. These changes in the tax group, important thing is when these changes will be effective. So we have summarized the changes into 4 categories. If you're submitting the applications, you are failing to meet the conditions, you're leaving the tax group, or there's a possibility you are a new company. Based upon this, the changes will be effective. This is more or less the same thing. You need to go through this in detail. Then we'll discuss taxable. How can you calculate the taxable income of the tax group? Tax group can be calculated by consolidating the number, eliminating the intra-group transactions. If subsidiary joining, if the existing group, what will be the treatment of the group losses? Then we'll look gone through the various examples as well. So when this clawback will be able, in our coming lecture, we will be primarily focusing on this clawback within 2 years from the date of the transfer and qualifying group relief, and we'll see other provisions of the law which will be applicable on the corporate tax group. We are trying our best to finish this, but the guide is such a long guide, and we want you need to understand thoroughly. So this is taking time. We'll try to sum it up in our coming lecture. So one or maximum next 2 lectures. So if you have any question, you are most welcome. No question? Okay, guys, thank you very much. Faiza, thank you very much.
Thank you,
So,
everyone.
lovely evening to everyone. Thank you.
Thank you.
Thank you. Bye-bye. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.